All right, so in the last lecture, we studied till non-current assets. And let's just quickly revise what we said last day. That, okay, property, plant, and equipment belongs to both parent plus subsidiary, and we did fair value adjustment in it. Like if the assets of the subsidiary is actually has more value in the market, then we will be adding that thing and we'll be deducting that extra depreciation. And if it is vice versa, like say for example, if the fair value is less than the carrying value, then we will be deducting the fair value and we'll be adding back the extra depreciation. This is what we studied last day. And then we studied, okay, that goodwill is actually what you have paid more than their net assets, and it is for the things which is not accounted for within the financial statement, such as you are paying for their reputation, you are paying for their customer base, for their market share, for their skilled employees, because obviously they have not recorded those things within their financial statement because they cannot assign the value to those things. You cannot assign value to your employees, you cannot assign the value to your customer base, to your reputation, but obviously they will be cashing up that thing. They will be actually charging you for that stuff they have created over the time and you will be paying them more than their net assets, and that is known as the goodwill. Then we said that, okay, investment of parent plus subsidiary should be consolidated. Parent plus subsidiary, and we gonna deduct the parent investment in subsidiary. So we're gonna eliminate that. Other than that, all will be consolidated. Investment in associate, it has a separate working. We'll be discussing that soon. Now, we are starting from the current assets. If you see the current assets, you have first of all the inventory. So inventory again has the same rule. Okay, we are going to take inventory of parent plus subsidiary. And then you have GIT, which means goods in transit. The concept of the goods in transit is that parent and subsidiary has sent goods to each other. Like for example, if parent has sent to subsidiary or subsidiary has sent to the parent, but those goods are still in transit, they are not received. So that means it is not recorded. So you need to record it. What you will be doing, you will actually record that thing, debit inventory, because obviously one day it will be received, so you're going to receive it, debit inventory, and credit payables, because the corresponding payable will be recorded as well. So debit inventory and credit payables. Then you have the concept of unrealized profit, which I said last day. Unrealized profit, that we need to eliminate some certain things. And why we are eliminating that thing? Because of the single entity concept. If it is a single entity, then they should not charge profit from each other. The concept is that parent has sent goods to the subsidiary, or subsidiary has sent goods to the parent. Okay, sold goods on profit. So now they have goods, and these goods includes the profit which has been charged either by a subsidiary or parent. If these goods are sold to third party outside the group, if these goods are sold by parent or subsidiary to someone else, then all profit is realized and there is no unrealized profit. But if the goods are still in stock, that means there is the concept of unrealized profit, that if the goods are still in stock, then on that inventory there is unrealized profit. And you need to calculate that in the exam. Obviously, you are required to calculate that thing in the exam. So examiner will be telling you that parent sold the goods to the subsidiary of this value at this margin or markup. Now let's recall what you have studied in F3, that in margin, sale is 100%. So if the profit is 20%, then that means cost will be 80%. In the markup, cost is 100%. So if the profit is 20% markup, then the sale will be 120%. 120%. So say for example, if they have stated you the sales amount, you will be dividing that over 100 and multiplying it by 20. If here you have the sales amount, here you will be dividing that by 120 and multiply by 20. That will give you the profit that has been earned. Profit margin, profit markup. But the examiner will be specifying you one more thing. The examiner will be telling you that half of the goods are in stock, 1/3 of the goods are in stock, or complete goods are in stock. So say for example, they are saying 1/3, then you will be multiplying this by 1/3. For example, they are saying half of the goods are in stock, then you will be multiplying it 1/2 or 50%. So this is how you're going to calculate the unrealized profit. It will be given to you in the exam that this is the percentage that they have charged. You'll be giving the sales amount, and then you're going to calculate the markup and the margin. So once you have calculated the unrealized profit, so inventory will be parent plus subsidiary plus goods in transit and minus unrealized profit. So you'll be deducting that minus unrealized profit. Because the profit is still in stock, that is why you are reducing it from the inventory. So inventory is done. Then you have trade receivables. Okay, now let's come to the trade receivables. Okay, trade receivables, parent plus subsidiary, and it is written minus cash in transit and minus intra-group. Remember one thing that I said last day, that you need to remove the intra-group balances. Intra-group balances mean like parent and subsidiary has traded with each other, and obviously if they have traded with each other, in one's books there will be receivable and in other books there will be payable. So because this is a single entity, you need to remove the balances. But it is possible that the examiner says you, just like in the inventory, that the examiner gonna say you that their balance does not match due to the goods in transit, and then you need to pass the double entry of the goods in transit. Examiner may also specify you that their balance does not match due to cash in transit. So cash in transit is just like goods in transit, that the cash has been sent by one party to the other, but that has not been received. So what we'll be doing is debit cash and credit receivables. So that is why if you see, I have actually deducted this cash in transit receivables. This is this entry. Sorry. Then when you adjust the cash in transit, the balance gonna match, and then you will be actually deducting the intra-group balances. So debit payables to eliminate the payables, and credit receivables to eliminate the receivables. So this is this entry that you are actually removing the intra-group receivables. Then you have the bank. Okay, bank has the same concept, bank balance of the parent plus bank balance of the subsidiary. And obviously now this cash will be recorded over here, cash in transit plus cash in transit. So receivable will be deducted and cash will be added in the cash. So this is how you deal with the current asset, trade receivables and bank, and that will give you the total assets. Then you have the equity and liabilities. And if you remember, in the equity and liabilities, I said that the share capital and share premium will be of parent only, because you are consolidating the assets and liabilities, so there is no need to consolidate the net assets. So equity shares, that means share capital plus share premium, will be of parent only. And now there is one more point as well over here. So when you have the share capital and share premium, what you will be doing, you will be taking the share capital from the balance sheet, that means statement of financial position of parent only. Remember one thing, share capital of parent only and share premium again of parent only. And then you will be adding that the share exchange. You will be adding that the share exchange. Now, what is share exchange? The parent has bought shares of the subsidiary. And obviously, when they have bought the shares of the subsidiary, they need to pay them for those shares. That is known as consideration. Consideration may have many types. They can pay cash, they can issue loan notes, they can pay cash in the future, that is known as deferred consideration. We'll be studying that in a while. And one thing is known as share exchange. The concept of the share exchange is that the parent company has bought the shares of the subsidiary, and in exchange, they are issuing the shares of itself. In exchange, they are issuing their own shares. So what we're going to do now, we can calculate the share exchange. How we can calculate? We can calculate the total shares of subsidiary. This will be given in the subsidiaries balance sheet, so you can take from that. And then you will be multiplying it by the percentage you have acquired, percentage of acquisition. How much percentage the parent has acquired. So that will give you the shares which belongs to the parent. Then you will be multiplying it by fraction. Fraction. What is fraction? In exam, examiner will be telling you that the parent has issued the shares in the fraction of, like, for example, 1 for every 5, 2 for 5, for example, 3 for 5, whatever. When you multiply it by fraction, that gives you the number of shares that is issued by the parent. And that will be multiplied by parent's share price. When it is multiplied by parent share price, it will give you the consideration in which is in the form of share exchange. The amount of shares actually the parent has issued to the subsidiary. So this is a detailed calculation. First of all, you will be taking the total shares of the subsidiary, multiply it by percentage of acquisition. It gives you the number of shares which belongs to us. Then we multiply it by a fraction, that gives you the number of shares issued by the parent. And then you multiply it by parent share price, which will be given in the exam. Then it gives you the total amount that has been paid to the subsidiary regarding the share exchange. So the entry will be debit cost of investment, credit share capital, and credit share premium. This is the basic entry that you have studied in your F3. But the only difference is there you were debiting cash, and here, because this share exchange is part of investment, that is why you are debiting the investment and crediting the share capital and crediting the share premium. And hopefully you remember that the share capital is up to the par value, face value, or nominal value. And above par value is actually the premium. So say, for example, if the par value is 1 and the parent share price is $5, so up to $1, it will be included in the share capital, and the $4 will be recorded in the share premium. This is known as share exchange. So you will be taking the statement of financial position, and you will be adding share exchange into it. Then you have the retained earnings. Retained earning will be calculated through working. We'll be dealing that soon. Then you have the non-controlling interest, which is the portion which we have not acquired. So that means that will be recorded between equity and liabilities because we are consolidating 100% subsidiary. That is why we need to show this between equity and liabilities. That gives you the total equity. Then you have the non-current liabilities of the parent and the subsidiary. Then you have the current liabilities. In the current liabilities, the first thing is the trade payable. And trade payable of the parent plus trade payable of the subsidiary. And if you see, then there is goods in transit payable. Now let's go back to what we have studied. Trade payables. This was actually the entry of the goods in transit, debit inventory and credit payables. So we will be recording the corresponding payable in the trade payables. So this is corresponding goods in transit payable. And then if you remember the contra entry, what we said, where is that? Yes, here, this is the contra entry. So we deducted the receivable from the receivable balance, and now we'll be deducting the intra-group payable from here. So trade payable, parent plus subsidiary plus goods in transit payable. Then after adjusting this goods in transit payable, balance will be adjusted, and then we'll be deducting the intra-group payable. Then you have the concept of the contingent and deferred consideration. Now let's discuss these concepts in a bit detail. As I said that the consideration can be of many types. It can be of cash, loan notes, share exchange, contingent consideration, or deferred consideration. Both of the consideration belongs to the future. Both of the consideration belongs to the future. Say, for example, the parent is saying to the subsidiary, take this cash and the shares, and we will be paying you this amount, whatever it is, say, for example, $1 lakh, if your profit reached to a certain level, if your revenue reached to a certain level, if your share price go up to a certain level. So the parent is placing conditions over the subsidiary for the rest of the payment. That is known as contingent. Contingent means dependent. So the subsidiary's further payment is dependent on those targets. But the standard says that the contingent consideration should be recorded irrespective of condition being met. Even if in the question they say you that contingent consideration is this, but it will not be met, still the standard says that you should record the contingent consideration. Still you need to record the contingent consideration. Okay, so what you're going to do, obviously you need to consider the probability. Say for example, you can reduce the amount through that, but still in the F7 level you need to remember this thing, that contingent consideration will be recorded irrespective of the condition being met. Similarly, deferred consideration is actually, like for example, if you say we will be paying you some further amount which is not dependent on any condition, say for example after 2 years. So these both of the consideration belongs to the future. So if these consideration belongs to the future, then obviously we need to calculate the present value. So present value, PV is equal to present value, is equal to future value, and this concept, hopefully you remember it, you have studied in F2. Present value equals to the future value 1 plus R. R is the rate of interest through which we are going to do the discounting, raised to power minus n, and n is the number of years. So say for example, you have to pay 1 lakh after 2 years. 1 lakh after 2 years. Okay. So, and the rate of interest is 10%. So if we write it in decimal, so it will be 0.1 and minus 2 after 2 years. So 1 lakh, first of all, you need to solve the bracket. It will give you 0.826. So it will give you the 82,600. So the 1 lakh which will be paid after 2 years, now it has the value of 82,600 at acquisition. At acquisition, the value is 82,600. Okay, what you will be doing, you will be debiting the cost of investment because this is part of investment, and you will be crediting the liability because you have to pay it. But obviously you are required to pay 1 lakh, not 82,600. So you're going to increase the value 1 year and in the second year. So in the first year, you will be increasing that value. That is known as unwinding. Unwinding. Obviously, we have to pay 1 lakh. So this 82,600 is the present value. So what we'll be doing, 82,600 multiply by 10%, it gives you 8260. So after 1 year, that means at reporting date, the liability will be 82,600 plus 8260, that gives you 90,900. I hope so. So that means you need to increase your liability. At the year end, the liability will be 90,900. So this will be the, what will be the entry? So this will be debited to the profit or loss, as this unwinding is the finance cost, and credit is the liability because liability was recorded on 82,600, and by the year end it will be recorded on 90,900. Again, in the next year, this 90,900 will again be unwinded, and it will reach to 1 lakh automatically by the end of the second year. So what we do is we bring the contingent or deferred consideration to the present value, and then we unwind it so that it may reach to the original amount of 1 lakh. So this concept is known as unwinding, and these are the deferred or the contingent consideration. Then you have the overdraft, parent plus subsidiary. Then you have the taxation, parent plus subsidiary, and it gives you the total equity and liabilities. So this is the consolidated statement of financial position, and obviously this is the main format. We'll be discussing now the workings.